We remain very much in the camp that the significant inflationary pressures that we're seeing today will ultimately prove transitory as the structural forces well in place prior to the pandemic resume their downward pressure on prices. Increased use of technology and challenging demographic trends have only been exacerbated by COVID-19. There is one area, however, that we believe bears watching as we think through the debate about inflation, and that's energy. The price of WTI crude is up over 85% year over year and back to levels not seen since 2018. Although we think core inflation will remain range-bound and low over the intermediate term, there are reasons why energy prices will be volatile and could rise further from here. The reasons? Let's break it down. So first, the reopening of global economies is still underway, and although the U.S. is likely peaking sometime in the third quarter, we believe the developed economies outside the U.S. will maintain strong and positive momentum into 2022, so demand is expected to stay robust. This is particularly the case as we think through the unclogging of global supply chains in the latter part of this year. That's going to require significant energy inputs. Second, we're not seeing a typical reaction function from the energy industry. In prior periods of significant mismatches between supply and demand, when prices have risen this fast, we typically have observed more drills in the ground. We don't see that this time, and energy producers are not increasing supply to meet the spike in demand. For context, the U.S. oil-directed rig count remains well below pre-pandemic levels. Even OPEC has been able to maintain supply discipline, increasing output only gradually as prices rise. And that brings me to the third issue, capital discipline. Companies are much more disciplined with their use of capital right now. They're reluctant to start new projects and preferring to protect stock and bondholder interests and focus instead on operational efficiency. The bottom line is that although overall inflation pressures may be transitory, we could see persistence in the price increases for oil and gas. Investors should maintain positions in equity-based natural resources. Those are companies that benefit from higher prices, and the exposure represents a durable inflation hedge as well.